Hello everybody, my name is Mark. Welcome to another one of my investing videos, and in this video, this is video number 2 in my short little video series on strangles. Strangle is an option strategy. It's a strategy that you can use with stock options on a stock that you think is going to move up or down. You're not sure which way it's going to move, so that's why that you use this particular strategy. And in the first strategy was in the first video was kind of an intro video, went over the basics. What is a strangle and how do you make money on it? Buying calls and buying puts on the same stock. You can do different strike prices. If you did the same strike price, then it would be called a straddle with a D. Different strike prices is a strangle with a NGL. But don't get hung up on the vocabulary, just understand the basic idea of what I'm doing here. So in this video, I am actually going to show you that I put this strategy into action and I made a little bit of dough. I made a little bit of ka-ching, ding ding money. So let's go ahead and do that. Now, I did it 3 times on 3 different stocks. I did it on Twitter, I did it on Apple, and I did it on Square. So first, let's look at my Twitter one. So let's go to transactions and let's put in Twitter, and I would have did this back in late July, right before the earnings came out last month. And so I'm gonna put in July the 20th. That's pretty close about when I would have done it, and then I'm gonna click the view. And there you go. On the 20th, you can, that's the 20th right there, you can see that I bought 2 right there. I bought 2 calls at $12, which is $1,200 per contract. I bought 2 of them. They were $40 calls, and I bought them for long term, January of 2020. So I did this all improperly. This is not the way. This was the first time I ever did a strangle in my life, and given that I didn't know what I was doing and that I still made money, I feel kind of good about that. I don't feel bad that I botched it all up, and I could have made a lot of money, but I made a little money. You don't want to buy expensive options when you're doing this particular thing. You want to buy the cheaper ones because it gives you more contracts, which means you can make more money. But it is what it is. I've always been very conservative, and so I kind of threw in my normal mindset into a strangle mindset, and I didn't make as much money. So anyways, here you go. These are the red numbers, and that's the money that I put up, right? I bought 2 calls at $12 a contract, and then I bought 2 puts at $23.55 a contract, which would be $2,355 times 2, and so that's all the money that I put up. $4,718.48 right here, plus $2,408. Total cost of a little over $7,000, something like $7,100, and that was on the 20th. And then a week later, after the earnings come out, I sold and I made a little profit. I should have made a lot of profit, but I made a little profit. So I don't feel too bad about that because it's the first time I've ever done a strangle. But let's go ahead and plug in the numbers here. So what I'm going to do is I'm going to add the green numbers together, and then I'm going to subtract the red numbers, and that will show you my total profit here. So let's go ahead and pull up the calculator, and let's plug in the green numbers first. So 5891.44 plus 1411.5, and now minus the red numbers. So minus 2408.48 minus 4718.48, and so I made $175.98, and so I did that on a total investment of I'm going to try to remember that number. I'll put out so I can get the exact return here. I'm going to add these red numbers together, and then I'm going to divide that into this 175.98, and that's going to give me my return, my percentage. That will be the percent return that I got from the 20th to the 27th. So 175.98, that's the number I got to remember. So let's add the red numbers together. 4718.48 plus 2408.48 equals, so 7126.96. So now 175 into that number. Now, because my memory is a little bit splotchy, I'm just going to divide 175 into 7126 just to make it easy. So 175 divided by 7126, and so I made a 2.4% return between those two dates, July 20th and July 27th. So absolutely no complaints with the money that I made. I'm very happy making $175. I would have made a heck of a lot more money if I would have bought cheaper calls and puts. Reason being, if I go back to Twitter and I show you what Twitter did when the earnings came out, let's pull up the chart, and there you see it. It went down like James Brown, right? It was up at the $45 level and went all the way down to like 35. So if I would have bought cheaper puts, I would have made several $100s instead of making $175. But I'm not complaining about making $175 and making a 2% return. No complaints at all. So let's move on to the next stock. Okay, that was a strangle. I bought calls and I bought puts, knowing that earnings are coming out and holding my belief that Twitter's going to go up or down. It happened to go down, but if it would have went up, I would have made the same money. As long as it goes up. If it doesn't move, then I start losing money, and I would probably get out of the position and lose a couple $100, right? So that's the risk of a strangle. But it's like anything else, you don't put all your money into one strangle, right? I'd be very happy if I did put all my money, 2% at 28 grand, I would have made over $500, and that would have been nice. But I'm not that kind of person. I don't put all my eggs in one basket. So let's go on to the next one, Apple. And again, let's go back to July, and let's put in Apple and hit the view button, and there you go. So on this one, this was a day trade. You can see I did this on July 27th. I bought 3 Apple calls at $350 a contract, and then I bought 3 Apple puts at $350 a contract, and that was on July 27th. And if you notice, the next 2 that I sold was on the same day, July 27th. So this was a day trade that I did, and I made a little bit of money on this. So let's go ahead and plug in the numbers. The green numbers, I'm going to add those together. That's my proceeds, and the red numbers, that's the money that I spent when I first got into the position and did this little strangle. Again, I'm buying 3 calls and I'm buying 3 puts. That's a strangle, buying calls and puts on the same stock simultaneously, believing that the stock's going to go up or down. So let's go ahead, pull up the calculator, and let's erase that, and let's put in the green numbers first. 1226.72, and then plus 941.73, and now minus the red numbers, minus 1059.25, minus 1059.25, and there you go. I made an outstanding $49.95. So round it up to 50 bucks. I made 50 bucks in a day trade. Not too bad. Now let's divide 50 into the total investment. So total investment was 1059.25 times 2, so it would have been $2,100 and like $20. So let's round it down to $2,100, and let's divide 50 into 2,100 just to get rough estimates. I could certainly put in the exact numbers, but I like to be quick. So let's go ahead and divide 40. Let's divide 50 divided by 2,100, and there you go. I made a little over 2%, 2.3% return in a day trade. So I'm not unhappy at all about the performance that I had there. And again, I bought these calls and puts right before earnings, but I got out when I saw that I already made some money, and I thought, what the heck, you know, why not go ahead and get out and make what I got? So I made $50, and I didn't even wait for the earnings to come. So that's Apple. And now I'm going to move on to my third stock, which is Square. And Square I did in my other account, so I'm going to switch to my other account. This is not my Roth IRA, this is my margin account. I don't have a lot of money in my margin. I got most of my money in my Roth IRA. I wonder why. Could it be because I like making money tax-free? Might be. But I did do this one in my margin account. I do have a little bit of money in this margin account. So let's go ahead and pull up the transaction history. Let's go to July. Let's put in Square, and let's hit the view button. And there you go. So this would have been on July the 30th. I bought 2 Squares calls at $350 a contract, $65.50. Again, I did this one the right way, bought the cheap ones. And then I bought 2 puts at $352 a contract. You can see the money in red, that's the money that it's spent overall, a little over $700 a piece. And now if I would have tried buying 200 shares of Square, which was trading right at about $65, I would have had to come up with $13,000. So you tell me, which is less risky, to put up $13,000 or to put $700 up? Okay, so again, very good example why stock options are so much less risk than stocks, right? And people get hung up on the expiration day, and they think, well, it's going to expire, so that makes it risky. Okay, but what's the difference if you hold on to a loser stock simply because it doesn't expire? You got your money, you know, in a bad stock that's losing money because you just want to hold, and you don't, and you think, well, I didn't click the mouse, I didn't sell, it's just a paper loss, right? Well, I'm sorry, but if I log on to my account and I see big red numbers, then a paper loss is a loss. That's the way I look at it. So less risk. So let's go ahead and pull up the calculator and see how much money I made on this one. So again, now just to point out, I did something in between. Okay, here this would have been the next day on the 31st. I sold, and this would have been selling to open, 2 puts at the $56 strike price, took in $36 a contract, so a total of $63. And then the next day I got out because it dropped down to $14, bought it back for $36. So for about let's see, 63 minus 36, so I made about $27 in a day, which, you know, a little extra cushion for me, right? And I'm not even going to count that in the total strangle, because that's an extra trade that I did on this particular stock, and I did it because Square moved a lot the very next day, and so I thought I'd just make some safe money, and that's what I did. But I want to show you just the strangle. Okay, the strangle would be the 2 calls that I bought for $7.08, the 2 puts that I bought for $7.12, and then here on August the 2nd I closed out the position, sold the calls, got $14.31.50, sold the puts, got $71.52. So again, let's pull up the calculator and let's see how I did. So let's put in the green numbers. Where'd you go, Mr. Calculator? There you are. So 1431.5 plus 71.52, and now we're going to minus the red number, so minus 708.48 minus 712.48. And there you go. I made $82.06 in 3 days, July the 30th. And again, I did this right before earnings because stocks tend to go up and down when the earnings come out, because either the earnings report disappoints investor and it tanks, or it meets or even surpasses expectations and the stock goes up like a rocket ship. So in this case, Square went up a lot, and so the calls were worth a lot more than what I bought it for. I mean, if I would have just bought calls here, you see that I would have got invested $708, and then I would have got out for $1,431. I would have basically doubled my money, right? But since I don't have a crystal ball, that's not the game that I play. I like to do things that have a high likelihood of panning out and making money for me, and I don't mind. Let's find out what the return that I made is. So total investment would be about $1,400, right? A little more, but I'll round it down to 1,400, and then we'll divide 80 into 1,400, and that'll get close enough. So 80 divided by 1,400, and I made almost about a more than 5.5% return on my money, and I did that in 3 days. So I'm batting 1,000 on these strangles here. You know, luck has certainly gone my way doing this. So there you go, right? Strangle is a simple strategy, and all you have to do is find a stock that you like, the stock you think is going to go up or down, and then you click on that stock. Like, let's take a look at Netflix, and let's see what calls and puts are going for Netflix. So let's go like 11 days out, and these calls and puts are freaking expensive, but that's because Netflix is a very volatile stock. But if I was going to do a strangle on Netflix right now, if the market was open, I would buy these calls here, $317.15. The bid $760, the ask $780, so I'd spend $770 a contract, and then I'd buy the $315 puts, spend $700 a contract, the bid $690, the ask $710. They expire in 11 days, so if earnings were coming up next week, that's what I would do. And then I would just wait for Netflix to make its move. I get out, I sell the close, make my money, and I call it a day. So batting 1,000, it's a very simple strategy. If you need to, you can watch my first video on how to make money with strangles, and then you're ready to go to town. So that's it for this video. Thank you for watching. More to come, and I will see you in the next video.